Hi everyone. In recent years, we've witnessed the rise of Bitcoin, cryptocurrencies, and blockchain technology and how they have been influencing the economy, business, and society. But what do we really know about these digital innovations? How do they work? What are their implications? And why do they matter? Let's start by exploring them and continue with the opportunities and challenges they present for organizations. It all started in 2008 with a peer-reviewed article on Bitcoin explaining in detail how such a system can be executed. This 9-page article was written by someone or a group using the pseudonym Satoshi Nakamoto. Today, it's still unknown if it is one person or a group who wrote this article. To understand this system, we need to understand some basic concepts. Let's start with an example. Let's assume that the faculty gave our research group at Lyris some money to spend. Let's say that they gave us 3,000 euros. Each member of our research group, for example Bart, Monique and Almer, can use 1,000 euros for their research. Let's assume that the faculty gave the money, but they don't ask for receipts or how the money is spent. They always ask for proofs, but in our case, we assume they don't. We, Bart, Monique and Almer can spend this money to buy some devices such as laptops or hire students for our research. After some time, we come together to check our balance, and we see that we have 1,000 euros left. Now let's consider different scenarios for tracking who spent what. In the first case, we don't know who spent what, as we didn't keep a record. In the second case, each person keeps their own record. When we analyze these records, we notice a discrepancy. According to each person's record, 500 euros were spent, totaling 1,500 euros. Then we should have 1,500 euros remaining instead of 1,000. It is evident that there might be a mistake or even an instance of fraud. It appears that someone may have spent 500 euros twice, but recorded it only once. In the third case, to avoid such mistakes and fraud, we ask the dean of the faculty to keep our records as we all trust him. He is a trusted central authority in our example. Or instead of him, we can hire another trusted person, a company or a bank, to keep our records to ensure that each time someone spends money, it is recorded just like in the traditional economic system. In the fourth case, each person keeps a separate record of the money spent, and these records are updated regularly with timestamps so that we can compare the records anytime and we know who spent, how much money, and when. First, Bart spends 500 euros. Then, Monique spends 500 euros. Later, Almar spends 500 euros. And after a while, Almar spends another 500 euros. As the copies of the records are updated regularly, we know how much money is spent by each person. In summary, we have 4 cases. In the first case, we don't know who spent what, as we didn't keep a record. In the second case, people keeping their own records can lead to the possibility of mistakes and fraud. In the third case, to avoid mistakes and fraud, we ask the dean of the faculty to keep our records as we all trust him. In the fourth case, we each keep separate records each time someone spends money so that we can compare our records in case of a mistake. Without control, as in the first and second cases, double spending might be a problem. Double spending means spending the same money more than once. You cannot use the same banknote twice. Once it is exchanged for goods or services, it cannot be used again. This was one of the biggest challenges in constructing a secure and reliable system for digital currencies so that they cannot be copied, replicated, and spent in multiple transactions. In traditional systems, trusted central authorities are needed to avoid double spending. One of the trusted central authorities is the government. The government is responsible for printing money and keeping a record of how much money they printed. Other trusted central authorities are banks and companies such as PayPal. They are responsible for keeping a record of how much money each person has. Briefly, we can say, to avoid double spending, a trusted central authority keeps a ledger, a record of how much money is printed or how much money each person has. Let's elaborate on the role of trusted central authorities for different forms of money we have nowadays. We have cash transactions, which can be considered as peer-to-peer transactions. You use cash when you buy something directly from someone. The government is the central authority to check and avoid double spending for cash. We have electronic or digital money. The transaction is from the payer to the middleman and from the middleman to the receiver. An example is buying something using your credit card. The bank or company such as PayPal is the central authority to check and avoid double spending in this case. We have Bitcoin and other cryptocurrencies, which are also referred to as virtual money, digital currencies, or cash on the internet. While there is no need for a central authority or middleman, a control mechanism for preventing double spending is still necessary. Let me explain how this mechanism works in the context of Bitcoin. Bitcoin is the first decentralized digital currency. That is, Bitcoin is produced and managed without the involvement of a central authority. It operates in a peer-to-peer network without a central authority, such as a bank or another financial institution. It means that Bitcoin is controlled by its users via a massive open network of computers around the world using a transparent public ledger. Trust is not established by a central authority anymore, but by collaboration and cryptography in a peer-to-peer network. Similar to our examples, instead of a trusted central authority, the dean in our third case, each person participating in the system keeps records of each transaction as in case 4. This is similar to how peer-to-peer network works. To build this peer-to-peer control mechanism, Bitcoin uses ideas from cryptography. That is why we call it a cryptocurrency. Even though Bitcoin is the market leader, it's not the only cryptocurrency. Today, thousands of cryptocurrencies exist in the market, including Ethereum and Dogecoin. However, there are also untrustworthy cryptocurrencies created specifically for scamming purposes. Besides, legitimate cryptocurrencies are considered high-risk investments due to their volatile nature and other factors. Therefore, it's important that investors be cautious and conduct their own research before investing in cryptocurrency. To understand how the system works, we need to know some basic concepts. Let's start with blockchain. Blockchain is a decentralized, in other words, distributed digital ledger that enables the secure recording of the transactions and exchange of data and assets between participants in a peer-to-peer network. Each block in the blockchain contains a list of transactions that are verified by the network, as well as the hash of the previous block in its header. The hash of each block is a unique digital fingerprint linking the current block to the previous one. The name blockchain refers to this chain of blocks. As a result, Altering a block in the chain would require altering all subsequent blocks as well, which is computationally infeasible. This makes the blockchain a secure and tamper-evident way to store and transfer data without the need for intermediaries such as banks or governments. To send Bitcoin to someone, you start the process by creating a transaction specifying the amount of Bitcoin to send and the recipient's address. After initiation of the transaction, your digital wallet generates a digital signature to ensure the transaction's authenticity and prevent tampering. The transaction, along with the digital signature, is then broadcasted to the Bitcoin network for verification by other participants in the system called nodes. Nodes in the network validate the transaction by verifying the digital signature and checking your account balance to ensure you have sufficient funds. Once validated by nodes, your transaction along with other validated transactions is added to a new block. To add new blocks to the blockchain, miners on the network compete to solve a complex mathematical puzzle. The first miner to solve this puzzle is rewarded with Bitcoins. Now the new block, including your transaction, is added to the blockchain. This means that the transaction is complete and the recipient can access the received Bitcoins in their digital wallet. Proof of work is the consensus mechanism that requires network members to expend effort in solving the math puzzle we mentioned. The goal is to find a special number called a nonce. Similar to trying different combinations to unlock a safe, miners try random numbers to find nonce and combine it with other block information to create a unique hash using a specific mathematical formula called a hash function. The challenge is to find a nonce to produce a hash that meets certain criteria. In summary, we can say that a nonce is a random number added to the block header with the transactions and the previous block's hash to generate a hash for the new block. The nonce, block header, transactions, and the hash of the previous block collectively serve as input, while the hash is the output in this process. As a typical criterion, the output hash is expected to possess a specific number of leading zeros. The hash function takes the input data with any size or format and produces a fixed size output. Hash functions are one-way functions, which means it's easy to generate a hash from data, but it's practically impossible to recreate the original data from the hash. This makes hash functions useful for purposes such as data integrity checking, password storage, and digital signatures. Briefly, hash functions ensure the security and immutability of the blockchain, since any attempt to change the contents of a block would require the modification of all subsequent blocks in the chain. This is computationally infeasible because a substantial number of hashes are involved and each block is linked to the previous one through the hash of the previous block. Miners, a type of node, namely specialized computers connected to the network, validate transactions and create new blocks. Other nodes might be wallets, full nodes, and light nodes, which perform various functions in the network, such as communicating transactions, verifying blocks, and maintaining a copy of the blockchain ledger. Miners compete to find a valid nonce by repeatedly hashing the input data with different nonce values until the output hash meeting the criteria is found. This process, adding new transactions to blocks and creating new blocks, is called mining because it's similar to gold mining. The first miner finding a valid nonce broadcasts the new block to the network and then it's added to the blockchain. This miner receives transaction fees and bitcoins as a reward. Mining is a crucial component of the Bitcoin system as it facilitates processing and addition of new transactions to the blockchain in a decentralized and secure manner. We already mentioned that proof of work is a consensus algorithm used in many blockchain networks, including Bitcoin. Proof of work ensures that miners expend enough computational resources in finding a valid nonce. As the number of zero bits required in the hash increases, the difficulty of finding a valid nonce exponentially increases. In other words, the puzzle becomes more challenging. The proof of work consensus mechanism is designed to prevent a single entity or a group of malicious actors from dominating the network to enhance security and decentralization. However, proof of work has been criticized for contributing to climate change because the specialized computers used for mining require significant amounts of electrical power. That's why some cryptocurrencies are exploring alternative consensus mechanisms. Proof of stake is an alternative requiring less computational resources and energy. Yet, proof of stake has some drawbacks, including the potential for centralization, as wealthy individuals or entities holding large amounts of cryptocurrency may have greater control over the network. Bitcoin was designed as an alternative to traditional systems. But why would someone ever think of an alternative to traditional systems? Issues related to central authority, such as corruption and inflation, stimulated this idea. It was designed as an innovative way to manage and transfer funds with greater security, privacy, efficiency, and control. The first issue is related to safety and privacy. Third parties collect and control our data while our privacy is not fully protected. For example, hackers targeted servers of companies such as HSBC, JP Morgan, Yahoo, and LinkedIn. Even the European Central Bank was the target of an unsuccessful attempt. The second issue is related to ownership and control. Traditional systems give others the power to control your money so that they can block your access to your own money. Another issue is related to accessibility. Billions of people cannot access a bank either because they don't have enough money or because there is no bank nearby to open an account. Finally, efficiency issues related to traditional banking, such as international transfers taking 1 to a couple of days and being expensive. Let's talk about how cryptocurrencies deal with each of these issues and turn them into advantages. Cryptocurrencies are safe, transparent, and pseudonymous. Unlike traditional banking systems where ledgers are kept on centralized servers that are vulnerable to hacking and manipulation. For instance, the Bitcoin blockchain is constantly updated and verified by thousands of computers around the world, making it much more secure. Each computer on the network keeps a copy of the blockchain, which contains a record of every Bitcoin transaction ever made. This means that the balance of each account is publicly visible and cannot be altered without the consensus of the network. Yet, Bitcoin also offers a high degree of privacy as user identities are not linked to their accounts or wallets. To use Bitcoin, all a person needs is an internet connection and the necessary software. However, it's not completely immune to hacking or other security threats, even though the decentralized nature of the network makes it much more difficult to attack. Especially in the early years, Bitcoin transactions were faster and had lower fees compared to traditional banking transactions, particularly for international transactions. However, nowadays Bitcoin transaction fees can fluctuate depending on demand and might be higher than bank fees. Even when Bitcoin fees are lower, they can be slower and less reliable compared to bank transactions, as the banks improved their systems to offer faster and more cost-effective transaction options as a result of the competitive landscape. Cryptocurrencies maintain an accessibility advantage, allowing anyone with internet access to participate in the system. This feature makes them a potential solution for individuals who face challenges in opening a bank account, especially in the areas without nearby banks. You have more control over cryptocurrencies than traditional alternatives. When you work with third parties such as banks or other financial institutions, you give them full control to manage your accounts, to control your records, and to freeze your accounts. On the other hand, Bitcoin users have more control over their funds and can transfer them to anyone they choose without the need for intermediaries. What you only need is the private key to access your account. But what is the private key? To access your Bitcoin account, you have an address similar to your account number in a bank and a private key similar to your password or signature. Only the person who knows the private key can access a specific Bitcoin address and make transactions. If you lose the address, but you have the private key, you can still access your wallet. However, losing the private key means losing the access to your wallet permanently. As you see, cryptocurrencies have some downsides as well. Let's talk about them now. First, increasing cryptocurrency prices challenge scalability. For example, Bitcoin transaction fees can go up to $5 to $10 per transaction. Second, the value of cryptocurrencies is unstable and susceptible to speculations. Next, cryptocurrencies themselves are often built with strong security measures such as encryption and decentralized networks. However, the security of cryptocurrencies also depends on the actions of users, and issues such as malware attacks and social engineering can compromise the security of users' funds. We already mentioned about this one. Crypto wallets or accounts are not linked to the identity of the owners, which is an advantage in terms of privacy. However, if you lose your private key, you lose your account and money forever. Next, every cryptocurrency in the market might not be equally trustworthy. Finally, proof of work consumes too much energy and contributes to climate change. Some cryptocurrencies, such as Ethereum, are trying a more environmentally friendly alternative solution called proof of stake. As those are not optimal yet, better solutions for sustainability are needed. Having said that, let's shift our focus to the question, then why is Bitcoin or any cryptocurrency valuable? First, people agree that they are valuable. Next, people use them by accepting them as payment method or investment tool. Bitcoin or crypto debit cards and credit cards already exist for several years. Finally, limited supply of some cryptocurrencies like Bitcoin contributes to their value, creating scarcity and increasing demand. The maximum amount of Bitcoins that can ever exist is 21 million. This is built into the Bitcoin protocol and cannot be changed. Let's get back to the blockchain. We already mentioned that blockchain is a distributed database. Everyone can get a copy, and there are rules for adding new data to the network. Once the data is added, it becomes immutable, meaning it cannot be altered or deleted. While Bitcoin is the most well-known use case for blockchain technology, this technology has the potential to revolutionize many other industries by creating more efficient and trustworthy systems. Nowadays, there is a wide variety of blockchains with different architectures, including the distinction between public and private blockchains as one example. In public blockchain networks such as Bitcoin, all nodes in the network have access to identical information, all data is transparent to the computers in the network, and privacy is guaranteed using cryptography. In contrast, in private or permissioned blockchain networks, access to data is often restricted to specific participants. Unlike the transparent nature of public blockchains, only authorized nodes within the network may have access to certain data. This controlled approach allows for increased speed and scalability, but they are less decentralized and rely on a central authority for governance and security. Now let's dive into some real-world applications of blockchain technology to explore its adaptability in various sectors. First, blockchain facilitates fast and secure data sharing in many sectors. Second, Both internal and external audits become more accessible with permanent transaction records on the blockchain, enhancing accuracy. Next, for quality assurance, the blockchain ledger allows tracing back through different phases of the supply chain in case of issues. Blockchain also significantly reduces transaction processing time from days to minutes in stock exchanges, either for securities or commodities. Smart contracts enable the automatic completion of numerous transactions, enhancing efficiency. Another real-world application is in supply chain management. Blockchain technology offers a robust solution for tracking goods and materials within an organization's supply chain. Blockchain also ensures accurate, transparent, and secure voting processes. Finally, non-fungible tokens represent unique assets, such as digital artwork, providing distinct value compared to interchangeable and equal value fungible tokens like cryptocurrencies. This brings us to the benefits of using blockchain for organizations. In business, trust is crucial for transactions and data sharing between organizations. But what if they haven't worked together before? Absence of trust might be an obstacle. In such cases, blockchain can be a solution as data is stored safely on the network and cannot be altered. Think about different companies working together, for example, in a supply chain. They need to share information with each other, like suppliers, distributors, retailers. But here is the thing. Instead of one company managing everything, blockchain makes sharing info way easier without putting all the responsibility on just one company. The records on the blockchain are immutable. They cannot be altered or deleted. They are timestamped and linked to the previous block. This makes it possible to track information over time for secure and reliable auditing. Cryptography techniques such as hashing and digital signatures are used to ensure the integrity and authenticity of data. Data is immutable, and the blockchain keeps copies of records on nodes all around the world. As a result, hacking the blockchain is nearly impossible. You'd have to mess with every single transaction, and that's like trying to change history. However, this doesn't mean that there are no security risks when you use the blockchain. Blockchain processes transactions faster as third parties are eliminated and processes are automated, resulting in accurate and efficient processes. For example, Walmart uses blockchain technology to track the origins of their products in seconds, which used to take days with traditional methods. Tracing the origin of products, managing inventory, and responding to problems or questions is easier and faster with blockchain. European companies such as Carrefour also use blockchain to track the origins of their products. For instance, in case of contamination, identifying and removing a product from the shelves is easier and faster. Blockchain also offers a solution to optimize processes and deal with challenges in organizations. For instance, in HR departments, manually verifying the information on candidates' CVs is a time-consuming process. In a pilot study in the US, to solve this problem, universities authorized HR managers to access graduate data on a blockchain. Blockchain offers greater control over private data and privacy. For instance, smart contracts can be used to regulate what type of data is shared, who can access it, and for how long. Another example is the use of Bitcoin blockchain to record pseudonymized data, which helps to protect privacy of users. We should also mention some of the challenges in building and implementing blockchain in business context. First is scalability. Validating each transaction can slow down processing speeds, particularly when there is a large number of transactions. Then, while blockchain technology has robust security measures, it's not completely immune to security risks. Plus, substantial technical expertise is required due to the level of complexity. Building a blockchain solution for an organization requires not only technical expertise, but also expertise in other fields. Interoperability is another challenge, as support from other systems and processes is needed to verify the accuracy of data added to the blockchain. Communicating seamlessly between multiple blockchain networks can be challenging. And let's not forget the green factor. Energy consumption is a concern, and better solutions are needed to minimize energy consumption for environmentally sustainable solutions. These are just the tip of the iceberg. There could be other challenges beneath the surface that businesses really need to think through, weighing all the pros and cons before they decide if blockchain is the right fit for them. In conclusion, we can say that blockchain is a technology with great potential, offering diverse applications and benefits for businesses despite the challenges. And Bitcoin is the pioneer of digital currencies. It was originally introduced for digital payments, but now recognized as a financial asset. That's why people call it digital gold. Yet, the risks tied to the volatility and susceptibility to fluctuations in Bitcoin and other cryptocurrencies carry risks and requires cautious consideration before investment. Therefore, evaluating the potential benefits against the associated challenges ensures a balanced perspective in making strategic decisions about these kinds of innovations for organizations.